Bismillahirrahmanirrahim. Assalamu alaikum. Dear students, welcome back to my class. In this lecture, we are about to start chapter 7, that is rate of return analysis for one project. So, in the world, the most commonly quoted measure of economic growth for a project or alternative is its rate of return, which is also known as ROR. Whether it is an engineering project with cash flow estimates or an investment in a stock or bond. The rate of return is a well accepted way of determining if the project or investment is economically acceptable. Compared to the present worth or annual worth value, the ROR is a generally different type of measure of worth. Compared to the present worth or annual worth value, the ROR is a generically different type of measure of worth, as we will discuss in this chapter. So the correct procedures to calculate a rate of return using a present worth or annual worth relation will be discussed in this chapter, and some cautions necessary when the ROR technique is applied to a single project's cash flows. The ROR is known by other names such as internal rate of return, which is the technically correct term, and return on investment. We will discuss the computation of return on investment in the later part of this chapter. In some cases, more than one ROR value may satisfy the present worth or annual worth equation. Means more than one rate of returns are expected. So we'll also learn how to recognize the possibility of multiple ROR values. Alternatively, one reliable ROR value can be obtained by using additional information established separately from the project cash flows. Two of the techniques are covered for this purpose, the modified rate of return technique and the return on invested capital technique. Only one alternative is considered here, means we'll perform rate of return analysis in this chapter only for single project. In next chapter, we'll apply the same procedures for multiple projects. Now let's go through the course contents of chapter 7. First of all, we'll understand the meaning of ROR or rate of return. Then we'll learn how to calculate rate of return for cash flow series and what are some special considerations when using the rate of return method, and how to determine multiple ROR values. Finally, how to calculate external rate of return by using some information external to the project's cash flows. So let's start by understanding the internal rate of return. We have already learned present worth, that is equal to the sum of present worth of cash inflows minus sum of present worth of cash outflows. We calculate present worth at a certain interest rate and get either positive or negative value of present worth. So internal rate of return or rate of return is a rate that equates sum of present worth of cash inflows to present worth of cash outflows. It means this is a rate of return at which the present worth becomes zero. So it can also be defined as it is an interest rate at which present worth becomes zero. So this is a simple meaning, simple interpretation, or simple and easy to understand definition of rate of return or internal rate of return. So this is a rate of interest or discount rate at which present worth of a project or alternative become zero. Then present worth or net present worth and internal rate of return. So what is the relationship between present worth and rate of return, interest rate or discount rate? Here is a graph to show this relationship. On x-axis we have interest rate or discount rate, and on y-axis we have present worth. So if you see this line, this will show you the relationship between interest rate and present worth. So if you see, there is an inverse relationship between present worth and interest rate. Means if interest rate increase, our discount rate increase, the present worth will decrease. And if discount rate decreases, the present worth will increase. So if we see at 5% rate of interest, the present worth is almost about $900. So when the rate of interest is 10%, the present worth is almost $300. Similarly, at an rate of interest of 17.25%, the present worth becomes zero. So the rate of interest at which present worth is zero is known as internal rate of return. If we see 0% rate of interest, the present worth will be around $1,300. So from this slide, we can understand there is an inverse relationship between present worth and discount rate. It means if interest rate increases, present worth decreases, and if interest rate decreases, present worth increases. Now, the next thing is interpretation of rate of return. So, as we have already discussed many times, there are two perspectives to finance a rate of interest. One is of lender's perspective and other is of borrower's perspective. So we have to understand rate of return from the perspective of both borrower and lender. So from the perspective of someone who has borrowed money, the interest rate is applied to the unpaid balance so that the loan amount and interest rate are paid in full exactly with the last loan payment. In simple terms, if you borrow an amount from someone, at what portion of money you will pay the rate of interest? Will every time you pay on the amount you borrowed, or next time period you will pay interest on the remaining portion of the borrowed money? Similarly, in next portion you will deduct the amount that you have paid and you will pay on the remaining balance. So similarly with rate of return, this rate is calculated on the basis of unpaid balance. And from the perspective of lender of money, there is an unrecovered balance at each time period. The interest rate is the return on this unrecovered balance so that the total amount lent and the interest are recovered exactly with the last receipt. Rate of return describes both of these perspectives. So rate of return is the rate paid on the unpaid balance of borrowed money or the rate earned on the unrecovered balance of an investment, so that the final payment or receipt brings the balance to exactly zero with interest rate considered. The rate of return is expressed as a percent of period. For example, rate of interest, let's say 10% per year, it is stated as a positive percentage. The fact that interest paid on loan is actually a negative rate of return from the borrower's perspective is not considered. So the numerical value of interest rate can range from -100 to infinity. So in terms of an investment, a return of -100% is when the entire amount has lost. For example, if you have invested your money in a project and the project has gone bankrupt or unsuccessful, so you have to shut down your operations and you lost all your money. So in that case, rate of return will be -100%, means you have nothing left. The definition above doesn't state the rate of return, doesn't state that the rate of return is on the initial amount of the investment. Rather, it is on the unrecovered balance which changes each time period. So this point is key to understand the rate of return, because this rate is not calculated on the basis of initial amount or principal amount or initial investment. It is being calculated on the basis of uncovered portion or uncovered balance, which will change every time period. So keep this distinction in mind. So here is an example of rate of return. To get started in a new telecommuting position with AB Hammond Engineers, Jane took out a $1,000 loan at an interest rate of 10% per year for 4 years to buy home office equipment. From the lender's perspective, the investment in this young engineer is expected to produce an equivalent net cash flow of $315.47 for each of 4 years. Now, how we calculated this $315.47 per year for coming 4 years? Simply, we have to calculate annuity by using A over P factor. If we consider this 1,000 as present amount, 10% is rate of interest and 4 time periods. So this will be the equation. Annuity will be equal to present amount into A over P factor for 10% and 4 years. And by using A over P factor for 10% and 4 years, the resulting amount will be $315.47 per year for coming 4 years. This represents a 10% per year rate of return on the unrecovered balance. We have to compute the amount of the unrecovered investment for each of the 4 years using option A, the rate of return on the unrecovered balance. So in option, we'll use rate of return on the unrecovered balance and calculate. Then option B, the return on the initial investment. So in second option, we'll calculate interest on the basis of initial investment, which is 1,000, and 10% of 1,000 every year will be the interest amount. Then in requirement C, we have to explain why all of the initial $1,000 amount is not recovered by the final payment in part B. So we need to explain why plan B is not able to recover full amount, that is $1,000. So let's start with option A. So unrecovered balance using a rate of return of 10% on the unrecovered balance. So here we need to calculate interest on unrecovered amount each time period. So here first column is number of years, second column beginning unrecovered balance, third column interest on unrecovered balance, and fourth we have cash flows, and fifth we have recovered amount, and in last column we have ending unrecovered balance. So if we start at time 0, so the Jane borrowed the $1,000. So this is a negative cash flow from lender's perspective. So if you see what we are doing, we are making these calculations from lender's perspective. So from the lender's perspective. So be clear, these calculations are from lender's perspective. So once the lender lent $1,000, this will be considered as cash outflow from lender's perspective. That's why there is a negative sign, means negative cash flow or cash outflow. So recovered amount will be nothing at time 0, and ending unrecovered balance will be minus 1,000. Similarly, the beginning unrecovered balance at the start of first year will be $1,000. So we have to calculate interest on the basis of unrecovered balance. In first year, unrecovered is 1,000, so 10% of 1,000 will be 100. And cash flows, we now, here we have calculated $315.47 every year. So cash flow in first year will be $315.47. So 315.47 minus interest payment 100, remaining will be the recovered amount from principal. 315 minus 100 will be $215.47. Now we need to calculate ending unrecovered balance. So the ending unrecovered balance at time 0 was 1,000. Here we have recovered $215.47. So the ending unrecovered balance at the end of first year will be $784.53. In next time period, we'll calculate interest on the basis of this $784.53. So 10% of this amount will be $78.45, and cash flow in total are $315.47. So 315 minus 78.47, the remaining amount that is recovered is 237.02. and the ending unrecovered balance at the end of second year will be 784 minus 237.02, which is 547.51. In next time period, interest will be calculated at this amount, which is 547.51, and 10% of this amount will be 54.75, and total cash flows are 315.47 minus 54.75 will be the recovered amount out of principal, that is $260.72 in third year, and the remaining ending unrecovered balance will be 286.79. Next time period will calculate interest at $286.79, which is 28.68, and the total cash flow 315.47 minus this interest amount. The remaining recovered amount in fourth year will be 286.79. Now, if we add up these recovered amount, this will equate to $1,000, and the interest will be equal to 261.88. So by using unrecovered balance method, we have recovered exactly 1,000 at the end of fourth year. Now, unrecovered balance using 10% rate of return on initial amount. Now we have to calculate interest on the basis of initial amount. If we see first column is number of years, second beginning unrecovered balance, third interest on initial amount, and here is the difference. Here third column is interest on initial amount, and here third column was interest on unrecovered balance or on unrecovered amount. And fourth column similarly cash flows, fifth column recovered amount, and sixth column is ending unrecovered balance. So at time zero, we don't have any beginning amount, no interest amount, and cash flow is minus 1,000, no recovered amount, and ending unrecovered balance is $1,000. And at the start of first year, we'll have $1,000 beginning unrecovered balance, but we need to calculate interest every time on initial amount, which is $1,000. So 10% of 1,000 is $100. So the interest amount will be same each time period, and cash flow in total are 315 minus 100, 215.47. So if the interest amount is same, cash flows amount is same. Similarly, the recovered amount in each time period will be the same, which is $215.47. And ending unrecovered balance will be calculated 1,000 minus 215.47, 784.53 minus 215.47. This is equal to 569.06. So this amount minus 215.47, this will equal to 353.59, and this amount 353.59 minus 215.47 remaining will be 138.12. Now, if we calculate the interest amount throughout the years, this is $400, and the recovered amount calculate 215.47 each time period or multiply by 4, it will be equal to 861.88. And the unrecovered balance here is 138.12. So by using the rate of interest or rate of return on initial investment, we are unable to recover total amount, but we have recovered 400 in terms of interest. Now the option C was explain why all of the initial 1,000 amount is not recovered by the final payment in part B. We have to explain why we are unable to recover 1,000 when we are calculating interest on the basis of initial amount. Because here we are paying interest at the on the basis of initial amount, which is 1,000 and 10%. 10% of 1,000 is 100. But on the basis of unrecovered balance, we'll calculating in part B. So the amount of interest was decreasing each time period, and the initial and the original payment or payment of principal was increasing every time period. If you see, first time period is 215, second 237, 260, and 286. That's why we are able to recover 1,000 in option A, but not able to recover in option B, because we are paying interest, more interest than the initial amount. So this is the difference between both methods. Now we have to explain economical viability based on internal rate of return. If you remember, minimum attractive rate of return or MARR gives firm the idea about the cost of capital for their investment or how much capital should earn for them. So firm compare rate of return with their minimum attractive rate of return. Once you have calculated rate of return, if rate of return is greater than cost of capital MARR, then the project is suitable or economically viable. We should accept this project. And if rate of return is less than cost of capital, this is not a good investment or this is a bad project. We shouldn't undertake such kind of projects. In general, the higher the rate of return, the better the project. If rate of return is greater than or equal to MARR, accept the project as economically viable. If rate of return is less than MARR, the project is not economically viable. These criteria guarantee that the selected alternative will earn at least its required rate of return. So once you have calculated rate of return, compare it with MARR to have an idea whether this is a good investment or bad investment. So economic viability based on rate of return. Why we need to compare with MARR? As you know, minimum attractive rate of return is a minimum rate of return that the company wants to earn at least on its project to recover its expenses. That's why this is also known as hurdle rate, benchmark rate, or cutoff rate. We have discussed these terms earlier in detail. So ROR is the break-even rate of return for the firms. That's why they compare it with MARR, because ROR equates present worth of inflows to the present worth of outflows. That's why we have to compare rate of return with minimum attractive rate of return to have an idea whether we have got a good investment or bad investment. In the US, about 75% firms use ROR for evaluating their financial projects. So this is a widely used method of evaluating financial investments or projects. And another thing, that is rate of return is a relative measure. So we used MARR to calculate present worth, future worth, annual worth. This is a mathematical relation that determines the present worth value in actual monetary units, for example, in dollars, euros, or rupees. But MARR is established independent of any project's cash flows. On the other hand side, if we see, ROR values are calculated by using only the cash flows themselves of a project or alternative. As I explained earlier, rate of return is an interest rate that equates the present worth of inflows to the present worth of outflows, or this is a rate at which the present worth of inflows becomes equal to the present worth of outflows, or net present worth of a project becomes zero. So this is a relative measure because this is based on cash flows. Therefore, ROR may be considered as a relative measure while present worth and annual worth are absolute measures. Since ROR depends only on the cash flows of the product or alternative itself, the correct term for it is internal rate of return. However, the term ROR is used interchangeably. So as I explained that we calculate rate of return on the basis of a product's inflows and outflows. So both inflows and outflows are internal to the product. There is no external element in calculation of rate of return. That's why the correct term for rate of return is internal rate of return, and rate of return can be used interchangeably. So keep in mind why rate of return is known as internal rate of return. I hope everything is clear for everyone with regard to this lecture. If you have any question, you can write to me through your email, or you can just drop a message in WhatsApp group. I will try to respond to your queries as soon as possible. Stay safe. See you with next video. Allah Hafiz.